Hello and welcome to Lesson 3 of Unit 3 Finance. Now, in the last lesson, we looked at the internal and external sources of finance. We looked at debt finance and short-term borrowing, things like overdrafts, factoring, and bank bills. In this lesson, Lesson 3, we're going to look at debt financing, long-term borrowing. Still part of external financing, and we're also going to look at the second option of equity financing. Now we move to long-term borrowing. One of the ways of long-term borrowing is to go through a leasing concept. Leasing really involves purchasing assets, so that could be vehicles, plant, equipment, over a period of time. But the difference between purchasing the equipment and leasing the equipment is that the equipment does never belong to the company. They effectively pay an operating fee. There are two types. The operating lease, which is simple to manage. It's similar to a rental agreement, where the business will pay regular payments to the lessee. So the lessee being the business. So the lessee will pay regular payments to the lessor, which is the owner of the equipment. And the payment will meet the cost of using those pieces of equipment, be they a plant, equipment, or vehicles. A financial lease is slightly different. It means that the business will eventually purchase the asset. It's similar to a loan. The benefits of a lease is that it frees up capital for a business to invest into the future. Another form of long-term borrowing is something called debentures and unsecured notes. These are mainly for large businesses or government agencies, and they raise large amounts of capital. They offer fixed rates of interest, usually paid every 6 months, and that is similar to the bank bond that we talked about earlier. Debentures are secured by the assets of the business. Unsecured notes are not secured by the assets of the business. So a more secure way of doing business and investing money is through a debenture. It means that the investor has a guaranteed payment of interest on the money they invest in the business. Another way for business to get long-term borrowing is through loans and mortgages with the bank. Now, loans usually cover a 3 to 5 year period, and they must have security attached to them, which means that the business must put up maybe the assets of the business in order to secure the loan. Now, mortgage would usually be based around real estate, buildings, and over a longer period of time, and the bank would lend the money to the business. Another type of finance is equity finance. Equity finance involves raising capital by issuing new shares, rights issues, or purchase plans. The issuing of ordinary shares is basically issuing shares through the Australian Stock Exchange. Investors, the general public, will be able to buy shares. The money invested goes into the business for long-term growth. This is done through the stock exchange, the ASX, and this provides a market for people to buy and sell shares. A rights issue is similar, except it's a sale of new shares to existing shareholders. Usually if a shareholder has 10% of shares in the business, they're allowed to purchase 10% of the new shares. Another form of equity finance is share placements. This is when a business selects certain investors who they know will be interested in investing money in their business and buying more shares to invest in their business, purchase shares at a discounted rate. And then finally, private equity. This is when a private company purchases all the shares in a business and they effectively become the new owner of the business. Now, this can raise large amounts of finance for a business, but it must have the agreement of all the shareholders in the business. So that can be a very difficult thing to overcome.